Good morning. Thank you for joining us. It's not scary, but it is making everybody think again that is it only the weight of FI selling which is dragging the markets down, or there is something much more which we don't know today, but we could see in terms of the economy and earnings as things unfold in January?
Well, it's a combination of both, Nikunj. I think we need to go back to say why the market rallied up. It was purely because of demand and supply. That's what happened. A lot of people buying the stocks. Fundamentals became irrelevant at some point of time, and the market went up. We are now in a scenario where demand supply has got a major problem on one side only, and therefore what you see now is the fact that selling is happening relentlessly, and we're not the only ones. Global market is selling. So till some buyer comes in place, Indians are still buying. Your MF portfolios are still up in terms of inflows. They're still buying in the market. But the sentiment is down because globally there is no buyer in the secondary market. You don't see the same push in the primary market, as you must have seen. Venture capital deals still are going pretty well on good steam. But that's the problem, that when the market goes up by demand supply, not fundamental, you will face a correction. And whether we like it or not, Nikon, the fact is that high taxation policies of oil will ultimately bite consumption. It comes with a lag. So at the point of time, you don't realize what's going to happen. Now it's filtering through the system that you see the consumption slowing. And that's the peril in the economy. Everybody is foreseeing that consumption slowdown is actually for real compared to what we thought. And the only redeeming feature, to my mind, is that as elections come closer, inflation bites people and the votes, we might see reversal of those policies, which is good for the market. So I think to some extent, we are relying on the fact approaching election should give us some good news on both spending as well as on the taxes on oil, which should come down. And that's a right thing for do for an Indian economy.
So, is it time to buy the shakeout or this mini stampede? I'm not using words like crack and fear because look, we are still up 20% on the Nifty for this year, 40% plus on the Midcap index for the year. But in terms of in tactics, time to raise cash, protect cash, or buy this decline?
Yeah, I think it's a great time to be, because the whole thing which was laid out in October was you missed the rally, guys. You missed the rally. No, you not missed the rally. You got it again now. So you need to build your portfolio ground up. And I think there are sectors to which we think will add great value. Unfortunately, they're not in great favor at this point of time. So you may not see a great move up in textile, which is going to be the highest profitable segment of the economy. In my view, this is the time when you slowly start to buy into sectors which are going to have direct impact of the elections. That's the most important part. You go in and you buy the infrastructure stocks. You go in and you buy aluminum stock. You're going to buy metal stocks. You're going to buy economy stock at this point of time, because they will see the first benefit of the spending which the government will do in the next quarter. Well, the fear is that the highly valued stocks, I think these, particularly consumer stocks, which have a large chunk of holding in retail market, that's the problem. I think they will not move enough, or they might even correct more as consumption plays out. You already seen flight to safety. IT always remains the best bet. Rupee at 76 should go to 78. I think at that point of time, it went down to 74, which was unreasonable for it given the oil deficit. It's come back to 76. I think it's heading towards 78 or thereabouts. And therefore, there should be a good traction for all export industries, which is why for textiles. So, sum and substance, I think this is certainly not the time to sell. I do not think we should sell. If you're not sold by now, no reason to sell. If you're not in the economy stocks, good reason to be there. The only question mark remains whether banking, where we still remain doubtful, and it's a full year we haven't really bought a banking stock. So I think that's one question which I don't know how to answer. But till it doesn't catch up, banking, Indian indices cannot catch up. Nikunj, that's the problem.
So why are banks not catching up? It is not that there is a very scary outlook of NPAs. If at all, Q2 numbers were decent. If at all, NIMs were under control. If at all, credit growth is coming back. What is the issue here?
See, you say credit growth is coming back, but we ignore the fact that net of repayment, most banks were almost flat on their portfolio. That's one. So the basic premise of a bank is, lending portfolio is all skewed towards consumer credit. Now, whether we like it or not, consumer credit is more risky as an asset because unsecured loans are what they are at the end of the day. Therefore, one is on the demand side, they're facing attraction. Second, first time in their life, the banks face competition. New licenses, fintech players, everybody in the market now jumping in. And RBI, which had cocooned this banking sector, literally cocooned and said, make supernormal profits out of a struggling economy, is now unable to guide them towards profitability. Therefore, what they do is they bring the new NPA norm for NBFCs to say, let it par. The reason NBFC is a separate category is because they need separate governing mechanisms. But RBI, in an effort to protect the bank, is trying to bring NBFC down as well. So you have competition, basic demand, and third, more important, when you demonize default, to the point where promoters can't go out and all the stuff which goes around, you know about it. You kind of, the promoters question, and we talk to them is, why am I borrowing any money? Let me go slow. Let me get equity. Let me not do internal accruals. Let me not borrow. The basic philosophy in the system is, let's not borrow at this point of time. And that needs to change. I think we need to make commercial credit, commercial risk taking, not a legal impediment to people started to buy, and therefore they face personal impediments to even move out, or the children to move out. So when you demonize lending, you are basically hitting the basic framework of a bank to say how comfortable people are to lend. So demand, competition, I think both are now hurting the banks, and they haven't invested enough in technology to bring the cost down. So I think three things, and that's what's, I think, bothering all of us, and I'm sure bank management are equally bothered about it. That's what's, I think, bothering all of us, and I'm sure bank management are equally bothered about it.
Good morning, Ajay. The last time we had you on the channel, which was just before December started, around then, you had said despite all of the talk of fears, you had not taken cash off the table, that you not started to sell, but you were still not in banks and as well as FMCG. Now that we're checking in with you mid-December, is that still the position? You're also at that point said whatever money you had, you were putting in real estate investment trusts.
Absolutely. That's the real position today. I have almost zero investments in most consumer stocks, except I think we have gone in last month or so into something of this QSR kind of companies that we have bought, certainly, but that's not, I'll call it consumer goods, because I think in spite of Omicron, as the economy opens up, people order in, order out, whatever. I think QSR companies should do well. So that's the one buying. But consumer is zilch, absolutely. Bank is zilch, absolutely. And we continue to remain focused. As I said, I would say rather buy a textile or a REIT or investment trust at this point of time, because that's giving me good yield, and so does the metal stock. They're giving good yield. Vedanta, again, a dividend has come out. SAIL, a dividend has come out. NMDC, a 9 rupee dividend came out. So that's not a bad place to be, I think. And why risk my money with banks, which are really struggling, and consumer, which I think will struggle more. My guess is, come this Jan, Feb, March quarter, will struggle more. The only exception, I think, will be liquor companies. I think they will do exceedingly well because the marriage season has gone very well. I think somewhere people in North who will live, they'll understand what I'm saying, that our marriages are all about liquor in North India. I'm sure the same true for the rest of the country, but India more so. Therefore, I think liquor companies would produce absolutely stupendous results for this quarter.
Someone from North India and was stuck in long traffic jams this entire weekend because of wedding seasons. I will vouch for that as well. But Ajay, you're saying there are opportunities when it comes to liquor stocks. They're going to do really well. You've bought QSR as well. The last time you talked about a lot of corporate action-based deals which resulted in you buying. I think Forbes Advent, for example, was one of them. What else are you buying?
To be honest, nothing much. I think this is the time we need to go back and relax, because I think God has been kind this year, and you don't want to overcommit beyond it, because we're almost 95% to 98% invested. So I need to sell something to buy at this point of time. And same is true of global investors. I think the money flow has been very, very anemic at this point of time. So there's not enough money coming in to buy in the secondary market, to be honest, at this point of time. So you need money to buy, but money flow has been rather off late, not been the best. Therefore, stick with what we have, and whatever profits we have booked, I think I'm still putting more and more money in investment trust, because I think that will be a great, great story for the most investors, including us, as we get older and we have less potential for risk, less appetite for risk, more for return. So I think this time the portfolio remains basically where it is, heavily weighted toward economy stocks, industry stocks, and IT remains a small portion, but it is still there. We might start looking at in January pharma again, but that's let's take a call in January as to what happens to pharma. But that's one sector which should do well at rupee 876, but has been a laggard. So I think a good look at pharma possibly is in order in January.
You can see that some of the so-called ranked PMS stocks are falling. APL Apollo, Gati, Vaibhav Global. These are stocks which in a sense are Indian Hotels, Tata Com, these are stocks which in a sense are owned by a lot of PMSs. And I reckon that once you see a reversal in the market, that end of the market has not seen any sharp redemption, so to speak. So that I think for me is one of those big worries. There's a line in Hindi which I always say, Teji ka bol bhala, mandi ka muh kala. We've only seen Teji in this market in last 12-18 months and one-sided. But equity markets are turbulent. That's the nature. That's the reason why it's an high risk asset. Ajay, let's understand the large cap versus mid cap IT debate. Here's one sector where one of the biggest company, Accenture, is committing to a growth of 20%, almost 20%. And they are not using the word margin pressure at all, and they're using the words high growth and lot of visibility. But if I look at the P multiples, if I compare Wipro that within mid-cap IT or Infosys that again within mid-cap IT, even though large-cap companies are growing, they're far more efficient in terms of retaining talent and managing wage. Why P multiples of mid-cap IT are higher?
You know, I wish I could solve the conundrum, and a lot of industry has been trying to solve the conundrum. My guess is, and this only guess, Nikunj, that the large cap IT is owned primarily by FIs. The mid cap IT is owned primarily by retail PMS kind of investors. I think that's a dichotomy which is there. Therefore, when you see an unreasonable rise in the price of IT stocks, large ones, there possibly is supply coming into the market of a large kind to neutralize the effect. Therefore, there is no joy in buying a large IT stock, because the moment the valuation goes up, and you can see that very clearly in Infosys, XTC, etc., the selling comes immediately after that, and selling means delivery-based selling. It's not just like an intraday. But unlike in the mid-cap IT stocks, where the FIs are not so much prevalent, I think you don't see that kind of selling coming. You see a correction for a day or two, then you see buying again happening. So I think it's pure the nature of investors, which is there in the both segments, is dictating the price. Not saying people are not expecting smaller company ITs to grow faster than larger companies IT, or they will become a buyout candidate. That sure may happen. But the fact remains that the two different set of investors are making the return dynamics very different for both sets. And I think what you said right now, if the PMS cracks, I think that's the time you will see the dichotomy becoming hurting the investors, because valuation of mid cap is way above the large cap. We all know that. But if the supply starts to come to the market, absorption could become a problem. So therefore, I think my view is that it's only investors segments being two different ones is dictating what's happening. Number two is mutual funds in large cap IT are not seeing any large inflows. So there is no domestic buying also in large cap IT stock. But mid cap funds are seeing inflows still continuously. Therefore, their ability to buy mid cap IT stocks. And therefore, Indian mutual fund can't buy large IT stocks because IT funds are not getting any money. In fact, if you look at AUM, almost static. Therefore, who's the buyer for large IT stocks? It's only FIIs. That's I think, partly explains the dilemma of different valuations.
The Bank Nifty is down 3%, or I may say another 3%. Look at the 3-month underperformance of the Bank Nifty. It is absolutely unreal. Who would have thought that when economy was coming back, corporates are talking about capex, the Bank Nifty would have gone the other way around. There's a technical factor, but trust me, that technical factor may translate well into a ugly reality if the FI selling continues. SBI is down 3%, IDFC is down 3%, AU Bank is down 7%. Markets again getting worried about this entire unsecured liabilities for a lot of the banks. Ajay, what are markets pricing in about from the Omicron virus? What is the template which, to your mind, on the virus front is in the price?
See, strangely, Indian investors are pretty ambivalent about the Omicron. I think, it's something we say that, we heard this before. We saw it, we saw in March, we saw it in 2020, we saw in 21. This too shall pass. I think for so far, the strategy has been that this too shall pass because India has not seen any major curves or growth, etc. So I think that's one thing. And Indian export industries primarily are doing well because the more the local shutdown happens in the European countries or America, your ability to export becomes greater. So, so Indian industries, industrialists, business are seeing this as a great opportunity for export at this point of time because they see any market dislocation there. Means India is doing well because we are open fully at this point of time and we are. So I don't see any pricing of fear, which could be a danger that should Omicron become huge, we suddenly might have to correct our ideas about prices. But so far, I don't think market has been, or investors or companies are factoring in too much negative on Omicron. I don't think, I speak to a lot of companies, but none of them seems to be really worried that this is going to hurt their consumption or there'll be a lockdown or anything. I think more of them looking at opportunity for export rather than looking at it as a negative sense of fear of consumption slowdown in India because of Omicron. It may slow down for other reasons, which it will, we know the fact, but Omicron perhaps we are maybe underestimating, maybe becoming more realistic, but so far nothing much to fear on. Fear is not on the table for companies at this point of time.
What is your view on something like Tata Motors? It's a business which has got re-rated because of EV. Now the operating numbers are not there. As of now, it's like a belief and a story and a belief which is getting endorsed by Tatas. So markets are believing it. But shareholders would say FY23, FY24, what will happen on that front? Nothing. And the stock is pricing in that.
Well, globally, there is a shortage of cars. The fact is reported by everybody you talk to in the US and Europe, you're not able to get cars for six months. So I think on the demand side, for the first time, they are seeing a lot of good traction in the European market, American market. China is a different story, so leave it aside, and that's important for them at least. The key of Tata Motors, I think, is the separation of the company, which is the passenger vehicle. I think that event is going to be a great positive, and therefore you'll be able to focus too differently on industrial product vehicles as well as commercial vehicles. To an investor starved of fund, companies in this market, it's a kind of a manna from heaven because you got Tata, you got Chandrasekhar, the magic of Chandrasekhar, and the two separation of two companies, and therefore trucks become separate and the cars become separate. So I know it works well on a structural standpoint. And I think you and all the buyers in Tata Motors, I'm not a buyer, of course, but are a belief buyers, as you rightly said. But I still believe that the separation, the global market that we see so far, at least put some kind of cushion on the stock and the performance because they're not fighting for demand at this time. They're fighting for supply. And in India also, you see with what's happening in Ashok Leyland, there'll be management changes, etc., etc. Their biggest competitor is kind of lagging behind. And if infrastructure story plays out, both in America, which is the Biden agenda, as well as India, I think they've got a great move to at least on the demand side. So the first time in a decade, Tata Motors does not have a demand problem. They have a supply problem. And I think that's a great thing for the company. So it's not faith. I think global dynamics have been working in its favor. They have been patient with the company. They are now going to reap the good, I think, profits out of demand scenario, which is emerging on both sides, on commercial vehicle as well as passenger vehicles. I think it's going to be good for them for some time.
Ajay Srivastava, it's always a pleasure talking to you. Thanks so much for joining us live today on the market. And in case we don't speak again, here's wishing you happy holidays and a very happy new year.
Thank you very much. Thank you.